From Wall Street to Main Street to help small business owners have the same capital as corporate America and give them the same resources as a larger company. We cover business funding, business credit, scaling, business consulting, and much more. Check out the website at shieldadvisorygroup.com. Welcome to the show, The Liquid Lunch Project.
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan, alongside the professor, my partner, Luigi. Rosa Bianca, what's on tap today, Lou?
Matthew, I'm going to let you in on a little secret today. Do you know one of the best ways to accumulate wealth is through real estate?
No, never heard of that before.
Well, it is. And you know, one of our taglines is where Wall Street meets Main Street. So who better to have on the podcast than the CEO and founder of Invest on Main Street, Patrick Grimes. Patrick, welcome to the podcast.
I have enjoyed listening to your podcast, and so I'm really glad to get on here. You guys have a lot of fun with it. I'm sure we will today.
And we also would like to welcome Emery. Emery's first ever podcast performance. You're going to hear him chirping in the background. That's Patrick and his missus's newborn. So welcome to the world and to the podcast world, Emery.
Cheers to Emery with my espresso in hand.
So Patrick, what is it you do and how can you help small business owners invest on Main Street?
Small business owners are exactly where I came from and what I'm passionate to help out with. And most individuals, they are in a retirement account and they're trying to save up and they're frustrated with it. It's not growing. It's on inflation hedge and they're worried about being able to retire and they're worried about retiring and dwindling that down. And traditionally, it's all in the stock market. So Invest on Main Street specifically is founded to raise the awareness and the financial IQ of America to say, look, not only do you not have to be stuck in these qualified plans and follow the financial planner route, which means you work until you die mostly, or you can choose to invest in alternative investments, non-correlated to the stock market, ones that are rising and cash flowing, inflation hedge and tax advantage, that work, making money while you sleep and can accelerate your retirement and grow your cash flow and net worth so that you can leave something to your heirs on the backside of it. So we do that in both real estate as well as diversified energy funds, and they provide for a lot of flexibility for investors. So
Patrick, we're humble and also old enough to realize all that glitters isn't gold, right? So for example, one of our partners sent us over a marina deal to take a look at the other day. And I said, I'm not doing marinas. There's storms, there's hurricanes, there's flood insurance. Mm-hmm. So you obviously are a savvy professional. What's your real estate cookie cutter for not just cash flow, but also stability?
So you're speaking my language right now. In fact, even amongst my peers, I tend to be considered somewhat narrow. I think it comes back. I started as a machine design, automation, and robotics guy, doing robotic automation consulting, the small business kind of stuff. And I was dumped everything I had into some risky pre-development stuff, which wasn't stable. And I personally guaranteed. And then 8, 9, 10 happened, and I rode that down hard. And I lost it all. I struggled to get back into it, but I found recession resilient markets. So my buy boxes are places that did not lose huge in 08, 9, and 10 or bounce back quickly, but have diversified employment. I'm looking at markets that I can actually win during a recession and assets in those markets that are recession resilient. Specifically, look at the energy type markets as well as the real estate markets. We're looking for in apartment buildings on the real estate side, which are like 200 to 300 unit properties, existing construction, because I don't want to be hoping I can build and cash flow on the other side. But I want to buy something that's an income producing, cash flowing asset. I want to put enough down so that I know I can have a low vacancy and still cash flow and ride out a recession. For disasters, like you're saying, we save up a bunch of reserves. We raise an additional $1 million, $2 million, 6 to 8 months worth in operating reserves. So if we get hit by a storm, we can ride it out and be first in line to rebuild and then have insurance policies. So we're looking at exactly those fortified type, long-term financial or natural disaster resistant type assets, both in real estate and in multifamily. So you're definitely speaking my language on that.
Now, Patrick, is there a geographic zone that you and your partners tend to prefer? Like, for example, You're located in the Socialist Republic of California. I'm located in the Communist Republic of New York. Maybe for investments, there are better places. Like what should our small business conservative guys that look, they wake up in the morning and they put their blood, sweat, and tears. They don't want to get involved in speculative stuff.
Just for the record, I'm in the great state of Florida, so
He wins, I think. Definite win there. Yeah, and I was actually in Hawaii until Emory was born. So we relocated to sunny Southern California and Orange County to be near family here. So that's why we're here. But I think that from your listeners, they're thinking, well, I'm camped out and I have a business and I can't move it. But how do I invest in a place which is safe where I can have control over it, right? And people think, oh, in order to invest, I got to go buy it myself and control my investments like I do my business, which always is not in the best market. And that's what happened to me when I started building out my single family portfolio. I realized, well, I shouldn't be doing it in California because they hate on landlords. You can't evict. They have rent control now, and you can't raise rents. You can't have stable income. So it's a really bad place. So, I mean, we look specifically in those markets where if you're a business owner and you're going to and you have all these talented people and all these departments making money for you, you have all this profit, and you're going to set up another department of your business essentially to go and to invest all the profit that you make into some kind of investments, then it makes sense to set up shop for that department of your business, for your investment business that you don't realize you have, in the best markets possible. And where are people moving to? Where are businesses moving to? They're moving to the southeastern states and Texas. That's where we invest, where all the headquarters are transplanting, where it's friendly to employers, right? Where it's low cost of living, where it's legislative friendly to landlords, where you don't have rent control. You can raise the rents. You can evict if they stop paying you. And it is attractive to people and attractive to the right type of employers. So you have that kind of expansion curve with the right economics, and then you find the right asset, right? In addition to structuring it right with the right kind of debt. And so where can you do all that? There's just a handful of places in the southeastern states that we found that meet all of those. And even within cities, we find certain niches that are the best places to do.
Now, Patrick, infrastructure is important. Same goes for small business owners. We don't want that phone call where there's a leak or there's a flood or there's something wrong. Do you have in place for maintenance, upkeep, management, so that small business owner makes an investment but gets to sleep at night?
Yeah, so it's a really good question because it's part of the reason you have to scale. When I was doing the single family business on my own, right? And I call it a business because people think they're doing a side hustle. They're at their job working hard and they have a side hustle. I do real estate on the side. Well, it's a business whether or not you think it is. But the problem is it's subtracting from your high income earning job, and it's subtracting from time with your friendly friends and hobbies because you're dealing with tenants, toilets, and trash. Right? And so the reality is, in order to scale, in fact, I was moonlighting real estate until my wife, I met my future wife and I said, I have to stop. And she was there for my last single family closing. And then we got married. And then I said, look, we're going to trade up and partner up into better markets and scale into assets in larger apartment buildings when we can have property managers on site. We can have people, we're not calling and chasing them. They're calling me every Monday because we have over 80 units in the best markets where I can have on-site management, on-site service, on-site leasing, and I can have all the tools that I need to make sure my property is looked after daily. And that's really where it comes down to. All of our properties, most of our properties were vertically integrated, meaning we control the property management with our partners all the way to knocking on the door. And through COVID, that was critical because all of a sudden property managers were going broke because of, properties were falling apart. People stopped paying. They were stressed out. If you didn't control the management and the infrastructure, as you're pointing out, all the way to the door, then you can knock on the doors, figure out where they were, figure out which ones weren't going to pay, and then help them fill out the renter assistantships. It was exactly that infrastructure that allowed us to thrive during COVID. We didn't stop distributing during COVID, but we started picking up all these amazing deals from these other players that didn't have it. They had people not paying. They weren't able to pay their rents. They didn't have low enough leverage. And so it is absolutely critical that is the primary focus of the business.
So Patrick, when you isolate a property, what is the strategy? Is it a long-term buy and hold? Or are you looking to get out in 5 to 7 years? Or do you typically take your investors out at a certain period of time and move?
Well, the reality is I've never really held more than 5 years because, but we always say 5 to 10 years. We've all been through 2008 and seen what happens if although our properties are structured to survive a downturn, and it takes us about 2 years to renovate all the units in a 200 to 300 unit building. We do it slow enough so we cash flow the whole time, which means we'll have created the value and raised the rents up to market and appreciated this over a 2-year period. But we tend to just refi out their investment so they get their capital back and they can go reinvest it and then passively cash flow with no more capital in the deal. It tends to be our approach in the larger apartment buildings, not dissimilar from the energy deals. But then we say we'll hold it like 5 to 10 years, even though we can trade it forward through a 1031 exchange at any time at that point, because we just want to set the investor's expectation that, hey, we're cash flowing. If the market tanks, we're just going to ride it out, right? We don't want anybody upset. But if we trade it forward to another asset and do it again and continue to work hard for you, then it's a win.
So help me break this down for the audience and myself, because I'm not a smart guy at all. So let's say you got to be an accredited investor to come to you, first of all, right? So let's say me or Dr. Jones down the block, right? His business is doing great. He's got money sitting in a savings account. He's not making any money at all. He's paying 0.01%, if he's lucky. He knows he has to diversify because he doesn't want to work forever, right? So he comes to you and he says, Patrick, I got $250,000 to invest with you. What's a typical deal look like? And we're not going to hold you to the numbers, but just inside of it, 1 year, year 2, year 3, and at the exit, do they still own part of the property after you give them the money back and they get infinite cash flow moving forward, or are they out once you return their initial capital?
Well, so on the multifamily side and the energy side, they're all very similar. They have the same kind of investment inputs. They have monthly passive income and exit proceeds with similar timeframes. On the multifamily side, if you're an accredited investor, you got $200,000 in income, $300,000 when combined with your spouse, or $1 million in net worth, not including a personal residence. So one of those. If you don't have that, that's fine. Let me know. I can point you to some of my friends that don't require that, but they can't talk about it like I am right now. You have to kind of find them, which makes it tough, but I can help. But if you do that and you can invest $100,000, like for example, on our website right now, we have an open deal in Atlanta. It's a disadvantaged property, and you can come and invest in that. We start cash flowing immediately on the next 15th of the following month that you invest, and we're projecting about a 5.5% monthly passive income in the first year, goes up 6.5%, and then 7.5% the third year. But in the third year, as I was saying, we're doing a bunch of value add to the property. There's a building that burned down, and we're going to rebuild it, right? We're going to improve all the units, increase the rents just to meet today's market rates of $300 to $400 as we renovate them all. So we're going to have this huge appreciation. So we're going to grab that through a cash out refinance in that third year. We're projecting that between your monthly passive income, which isn't taxed, and the refinance, which isn't taxed, you should get your capital back about 95 cents on the dollar in year 3. Not all of it per se, but most of it. So it's mostly kind of that, you say, infinite returning at that point. You haven't lost any percentage ownership. You just got your capital back, tax deferred at that point. You're still cash flowing, to your point, until we sell, right? And that's a really great position, because now, hopefully in that year 4, 5, 6, you've reinvested it, hopefully with us, into another market, into another deal, and we're building a diversified set of income streams. On the energy side, it's exactly the same. You invest $100,000 minimum. It's been my case with all my deals I've ever done. Monthly passive income starts a little bit later, than maybe May this year. Starts about around that point, because we're going to have to drill some wells on some leases that we purchased, and then we're going to have a return of capital in 2 to 3 years, and then an exit in 3 to 5 years. And then if you want, we can trade you forward. Same kind of situation, but the cash flows are a little higher, and the exit's a little higher in energy, but there's a little more risk associated with it. And they offset that, the government gives you crazy tax advantages.
Yeah, let's talk about that a little bit, because we understand the advantages of real estate, right? It's a great strategy, right? Overall, just for the tax benefits. But let's talk about the write-offs that you can get in the energy portfolio that you have, or oil wells in general. How does that work?
Yeah, and I hear what you're saying. Most of my investors are exactly the same. They've invested a lot in real estate, and probably in like half a dozen different types of real estate. But now they want to diversify because real estate's not doing too good right now, right? But like real estate, it's an essential need. Housing, food, and energy are essential need. The IRS incentivizes those. To stimulate natural gas and oil production domestically, the IRS is given special incentives that are better than real estate. They don't just allow you to do depreciation on tangible assets like a building. You can get that as well as intangible assets that come not just off passive income like in real estate. Like you get a bunch of passive losses, you're just carrying forward as a business owner. In real estate, you can't use them off your active income. But in oil and gas drilling, you invest 100,000. Pretty much, we always pass forward at least a 75%, not depreciation, but intangible drilling costs. It's very unique to natural gas and oil drilling, and it's not a loophole. It's the IRS saying, thank you for investing your money where we need you to. Here's a huge tax incentive. Now, on that K1, that partnership return, instead of you just storing up all these losses like you do in real estate, it'll come right off your ordinary income. Or most of my investors, and I'm not a CPA financial planner attorney, so this isn't accounting, financial, or legal advice, but for most all our investors, if you invest 100K, that comes at like a $30,000 tax savings. If you invest 100K and you make 400,000, then the IRS typically only taxes you on 325,000. So they divide 75K off your taxable income on 100,000 investment. It's huge savings.
That is huge.
And yeah, the crazy thing is you're actually all in at 70K, right? But you had 100K invested, and now you're collecting your monthly passive income on 100K and an exit multiple on 100K, but you actually only invested 70 after taxes, right? And so it dramatically changes the table, especially since now you can 1031 exchange forward and continue to defer and kick the tax can down the road and make more and more money off the government's money.
So in the energy portfolio, you can do 1031 exchanges as well?
Yeah, so not with all energy
Really?
deals, but the specific diversified funds that we do, which are scaled across multiple states, and leases, which are hard tangible assets. We do have a 1031 exchange vehicle that allows you to take your return on capital and your exit. And we're putting together, we have in the past, but to reposition that through an exchange. So you don't have to deal with recapturing the government's incentive or deal with the capital gains. You can continue to carry it forward.
Luigi's smiling ear to ear right now.
You know, because Patrick, don't you love it? Every time my partner makes a self-deprecating comment on how he's not that sophisticated, he ends up asking a really, really complex, sophisticated question. So thank you for handling that really well. But I'd like to have you delve into something that really can apply to most business owners in America. And I know one of the creative strategies that you use is tapping into self-directed retirement plans. And we know that, I would say, if you're a small business owner with half a brain, you've got one of those. So how can small business owners tap into that to try to create some sexy cash flow via real estate?
Right. And what you're talking about is the majority of America, small business owners or entrepreneurs, CXOs, all those people have these qualified plans. And the vast amount of their wealth are in these qualified plans. And these qualified plans, there's 401ks, IRAs, Roth IRAs, all this stuff. And the typical American, actually, the average American has like 8% of their wealth in alternative assets and the rest of it in traditional investments in the stock market. High income earners have 25% in alternative assets and the rest of it. Ultra wealthy have 50% of their wealth in alternative investments like mine. But if you really want to start stepping up the ladder, how do you do it when most of your wealth is trapped in these qualified plans and your employer is saying, no, we're going to match it, and they're saying, no, you can't take it out? Well, the reality is, which is not well known, because they're not going to educate you on anything other than what they provide in these plans, especially that there's alternatives. the reality is, and I've got articles in Forbes, Patrick Grimes Forbes, IRAs and 401ks. You can read more details about how to do this or on my website. But the reality is you can take your qualified plans, a past 401k or an IRA, and you can create a self-directed variant of those. In fact, I use a solo 401k. Some people use an EQRP. There's probably a dozen different companies that I can rattle off that are highly reputable, that do self-directed IRAs and self-directed Roth IRAs that allow you to take a vast amount of your wealth in the stock market and stop riding that roller coaster. And most everybody's frustrated. Carve out a piece of it and start investing in real tangible assets that have inflation hedging, that have tax advantages, that are investing like the wealthy.
I'm going to jump in here for a second. So this is 100% possible. I spent 17 years on Wall Street. I've managed money. And every time somebody asked me, I said, why would you do that? Keep it in the market. It's going to grow better. The reason 99% of your financial advisors will tell you not to do this is because they're not going to get their management fees at the end of the year, right? Because they get paid about on a portion of the money that they manage for you, and they don't want it coming outside of Wall Street. So I'm very glad that you said that, Patrick, because 99% of people don't even know that it's even possible for them to do it.
Yeah, and unfortunately, they're going to take this conversation and they're going to go, "Oh, let me talk to my money guy. Let me talk to my financial planner, and then he's going to tell me the truth." And that poor guy, they don't do that well, and so they're trying to save your money in their control because that's what puts food on their family's plate. They work for an employer, financial planners, that only required them to go to 6 weeks worth of training to be called a financial planner, and they're not educated on anything else. So the unfortunate part is that where you're taking if you're a small business owner and you have all these highly trained, sophisticated people working for you and all these that are skilled, that are educated and all this stuff in all these different areas, you're taking all the profit from all of that and you're putting it into someone who's very narrowly educated and has a conflict of interest with diversifying those funds, that all the profit from your business, into something that will actually build you wealth. And so if you thought about your profit as, no, that is an investment business, and then you thought about, well, how would I handle that as a business owner now that I know I have an investment business, which is a book I'm writing, by the way, you wouldn't just give it to one guy. And you would give it to numerous people, and you'd diversify it, and you'd make sure that you hired the right people with the right education and portfolio to invest like the people you want to become, like the wealthy.
Yeah. These days you need a whole team. And listen, me and Luigi are both big believers in alternative investing and alternative assets in a portfolio. We do a lot of investing ourselves, and the majority of our investments are in alternative investments right now. Let's talk about the book that you wrote. You co-authored with a bunch of people.
Yeah, so I a couple of real estate colleagues and alternative investment guys. In fact, Phil Collins from the Def Leppard was one of the Brian Tracy wrote the foreword. There's NFL, NBA players. There's a dozen or so. It was a really great book. I had so much fun working with these guys, and it was a part of the project I was invited to be. It's called Persistence, Pivots, and Game Changers: Turning Challenges into Opportunities. And I'm here, and I still had hair prior to Emory and prior to COVID. But it did make an Amazon #1 bestseller, and I would be happy. And I tell my whole story, my snot-nosed engineering career, how I lost it all in real estate, got back into high tech with tail between the legs, got a master's engineering in business, started doing well again, then had to get back into real estate, scaled from single to multi, and got into diversified energy and got out. And now I do private equity full time. And I tell a lot of really good tips from a lot of different people. If you're interested, it's investonmainstreet.com, investonmainstreet.com/book. And if you type in the promo code, just put in the name of this podcast, and we'll send you a signed free copy. And I sign them and send them out. And if it contributes to your journey, just let me know. That'd be great. I'd be happy to do that for your listeners.
We love swag, Patrick. Thank you.
Patrick, you started with you got out of engineering, right, with small businesses. You moved to real estate. You're venturing, or you're not even venturing, in green energy portfolios. What's next? What are you thinking about?
Yes, we actually have a number of different additional lines, because when we got to about 500 million on the multifamily side, I met with my securities attorney, some other long-term investors, and said, look, we've been trading these alternative investments. Let's start opening them up to these real, especially now when real estate interest rates going up, valuations are waning, cash flows going down. Let's start presenting more options to our investor base. That we know the operators, we have the knowledge, the network, and the resources to find and do due diligence and vet these guys, but none of our busy professional investors do. So we're adding those, and we're doing diversified energy right now, which is just going incredible. And we're adding a couple more. One that's coming on very shortly is it's a single family affordable housing fund. So it's over 400 homes currently in a fund. We got about $5 million of sponsors funds, but the way it plays out is in this year when there's very little cash flow, when lots of real estate deals that were cash flowing stopped, many of the cash flow funds have started to dry out because interest rates are choking it. This fund pushes out 12.5% a year.
Wow.
Currently paid out, preferred return. You get 100% of the first 12.5%. And we're launching that just this next quarter. And it's the entire idea is it's government guaranteed rents, government guaranteed rental increases, diversified across many houses, and provides for the ability to cash flow at a time when there's just simply not cash flow.
12%. That's a nice number. I like that. Once you launch,
tax advantage too.
Absolutely. Once you launch that, we're going to have to get you back on. We'll discuss that a little bit more in depth further.
You know, Matt, one of the reasons we love having guys like Patrick on is not only for their expertise, but they've been doing this for so long, they get the options of all that deal flow. So they get to see a lot of deals simply because you're a victim of your own success. So thank you for providing a service to the small business industry. What's the next book? You just mentioned, you kind of gave us a teaser. You said you're writing another book.
I am. Yeah. In fact, I was just meeting just this last week on it with a team of guys, and we're targeting leadership in business leadership, and we're aiming for, our goal is to be a Wall Street Journal bestseller. And so we're aiming for all the titles and the structuring it in a way where we're speaking exactly to the audience on the Wall Street Journal list. And I'm going to be writing on that business, the investment business that every entrepreneur has. Because what I hear so often is that I'm so busy doing my cash flow thing that I only have time for a side hustle. I'm just putting money into a rental property and I can't really spend time on it. Well, the reality is it should be a department of every entrepreneur's, every small business owner business should be their investing business, and it should be treated that way. And to unveil how that works and how to make it easy and to give that education, that's really what I'm passionate about. Because I used to do that. I had a consulting business and doing automation and robotics. I did really well, but I didn't get married until I was 35. I married a 26-year-old, but I didn't get married until I was 30 because I was not marryable because I was so focused on my career and my side hustle that I wasn't able to spend time with my family, friends, and hobbies. Right now, I've done that. We're lived in Hawaii. I like mountaineer. We travel. I like to backpack, kite surf, spearfish, all that kind of. Now we have that ability, but people can take a shorter road if they start taking their investment business, part of their business, more serious sooner, and they get exposure to the assets that Luigi was very accurately pointing out you normally would not have exposure to. We're trying to provide that conduit. So that's what that's the theory. That's what I'm trying to ride on. And I'm really excited about it, obviously.
Sounds amazing. How's the process going for you? Because me and Luigi, we're in the fourth quarter right now of our book coming out. And it wasn't that easy, right? And there's just me and him. So you're working with a bunch of people. So how's that process flow together? Do you have somebody that runs the whole idea and then it's just that you have a whole team behind you like you do in investing? Is that the idea of it?
I'm a technical writer and I write for Forbes, and sorry, Ella, but you are the most amazing, because I write technically concepts around, investing, commercial real estate, and oil and gas. And she helps me draw out how to make this.
Dumb it down. She helps you dumb it down.
Simplify and stop the rambles and get the ideas more structured and readable and digestible. And so I have a lot. I mean, I speak on stages, poor people that show, I'm speaking on stages all about once a month now, but I'm learning a little more as I go. But yeah, of course, man, I have experience and lots of good knowledge to get out there, but I definitely utilize help from writing coaches and editors and, strategists. Like I said, we got a strategist on that.
Please make me a promise, and I'm gonna have you swear in a Bible. Make me a promise that when you're on stage, you'll never ever wear a black T-shirt.
Okay. Is that something Matthew did or what?
No, that's an inside joke. Every speaker wears a black T-shirt.
I think it's the official uniform of American masterminds. If you don't wear a black T-shirt, they don't let you up on the stage.
I'm still doing the engineering geek thing. I've still got the short sleeve with the oversized watch and
I think I see
the white collar on.
Right?
What was that?
I think I see a pocket protector. Is that right?
It's still a lapel mic parading as a pocket. I don't get to do engineering anymore, so I still look the part.
I think you're being very humble. I think that's part of your success because you brought that very severe analytics and just applied it to real estate. So I think that's why you're so succinct in your due diligence in finding these properties.
Also, a paralyzing fear of losing everything in another recession too. But yeah, it's certainly I got a master's in engineering with an emphasis in systems, and I did machine design, automation, and robotics. So you take the engineering kind of analytical problem solving, and you apply systems on top of that, so you can do rinse and repeat. You can keep control. You can adjust and tweak things. So I definitely apply a lot of that, and my desire to be the tortoise and not the hare. I don't have a desire to try and double and triple my money every year anymore because I know that leads to many years of painful crawling out of that, right, on the back end.
It's not what you make, it's what you keep at the end of the day.
Yeah. Mm-hmm.
Right. Patrick, we're really grateful for having you on. Thank you for coming on, sharing everything you're doing with our audience. Can you tell the audience where they can get in touch with you, how they can find you? I know we already spoke about the book. Are you on any of the socials?
Yeah, so investonmainstreet.com, invest on and then main and then street, all spelled out.com. There's a bunch of stuff there. In new investments, I have a bunch of articles in forums, recorded stages, a lot of education under investor resources. It's a lot of good stuff. I'd recommend just jumping in there and checking out, getting on our list. We send out a lot of educational content. We even have a video series my wife recorded. She's beautiful. She does animation producing, and she recorded 70 passive investor education videos. 1 minute to cash flow. You can wake up to, hi, my name is Shua. And she's just a little 95-pound Asian girl that smiles at you in the morning, teaches you a little bit about passive investing. I mean, it's really sweet. And I think we have really good network of people, a lot of followers. And, we've raised tens of millions of dollars. I think it was like over 50 million just in the last 14 months or something from individuals just like your listeners. So there's a big community behind it. I'd love to have any of them on there, and feel free to set up a call with me and contact page, and I get you pointed in the right direction.
One thing me and Luigi like to say here is you don't have to know how to do everything, but it's more of who you know. So Patrick is somebody in the real estate and diversified energy space that you guys should know. Take him up on his offer. Reach out to him. He'll help you out as much as he possibly can. With that being said, Patrick, we want to be respectful of your time and let you go. But I do have one last question for you.
Shoot.
If you could pick one state, and you're only allowed to invest in one state right now in real estate, what would it be?
Texas.
Texas.
Yeah.
Good old state of Texas.
Yeah. Mm-hmm.
Patrick, thank you so much for being here. Guys, that's a wrap of the Liquid Lunch Project. We'll see you on the next episode.
Thank you for listening to the show. And make sure you subscribe, leave a review, and share it with a friend. We'll see you on the next episode of the Liquid Lunch Project.